Good morning, and we are live. Welcome to the pre-market PulseScan with yours truly, Dex the Algo Capitalist, aka the Vulcan, coming to you live from PulseWaveTrading.com, home of the world famous PulseWave price trigger reports that we put right in your hand each and every trading day. What up to everybody in the live stream? Go ahead and smash that like button. What up, Mick? What up, Black Rob? What up, Sling? Yo, it's good to be back. Had a couple of days off handling some personal BI. And I see that every time Papa is away, all types of rats come out to play. What is up with that? Well, I have to tell you, man, I have been looking at things and I have been checking things, and it seems like the world just totally just went dark for 2 days. Just went dark. Darkness everywhere. The world is falling apart. Did y'all miss me that much? I know you did. Well, there is a plethora of things to talk about today as we're getting to a point, a tipping point where you can't lie your way out of this one. You know, for years, the mainstream media has lied and danced around certain things, pretending that it's not there. They just kind of tap dance their way out of things. But nah, not this time. The economy is affecting everyone. So we got economic issues, financial issues. Then we got civil unrest issues. Man, there's just issues on top of issues on top of issues. Yesterday, or was it? Yeah, was it yesterday? No, the day before yesterday. No, it was yesterday. Yesterday morning, I believe it was. No, the close of the day before. That's right, day before. My day is running together. What is it? Thursday already? Good grief. The time is just running together congruently like today is still Monday. All right, so we had that big rally right after the market closed and right as the evening session was opening, or the quote unquote next day session was starting in the futures. And you saw the stock index futures just take off like a rocket. Trump was basically like, yeah, man, we signed that China deal. Everything is good. Everything is going back. We got a cure for the coronavirus. Even though we don't have a cure for the flu or the common cold, we sure enough got a cure for what ails you with the coronavirus. Oh, and by the way, you know, even though we're no longer in the business of healing the body, we have found a cure for the COVID, though. We don't have a cure for anything else, even though we've spent $4.3 trillion in cancer research and we don't have a cure for cancer, but we sure enough figured out in the span of 3 months how to cure coronavirus. Oh yeah, we got that going on. Aren't we smart? Well, as you can see, that is not the case. Let's jump into these overnight markets, shall we, and take a look at what is happening. Are we having a red dawn morning? Is it possible that we're having a red dawn morning? Let's see. Here we go. We got the Dow futures down 164 points. Please bear in mind that this thing was down almost 300 points not long ago. We're sitting at 26,600. NASDAQ 100 right now is down 111 and a quarter points at 10,572. It was down another 100 plus points from where it is right now. It's off the lows. S&P 500 is down 19 and a half at 3,200 and a quarter. It was down also heavier than that. We got the Russell My Hustle down 7.5, trading at 1469.2, and it too is now off of the lows. It was lower. We got the mighty Bitcoin Futures Composite Index struggling to hold the 9,000 support. It is now down $95, trading at $90.95, right off of the overnight low of $90.40. That 9,000 needs to hold, ladies and gentlemen. You know what I was telling you. If you do not know what I'm talking about, then you need to check out last night's end of day report and the day priors. The last 2 days of end of day reports are very spectacular. We go way deep, way deep. So if you missed that, you need to go watch those the last two end of day reports, and you'll see what I'm talking about. Nat gas is up 2, trading at 179, so it is starting to rise. We had a rally alert on this one, I do believe, coming into today. All right, crude oil down 45, trading at $40.75 a barrel. It looked like it was going to try to make a little run for it before pulling back, and now it's just bouncing off of its lows. All right, so the long bond is trying to make a comeback. We're trading near the highs of the session at 180.9, which is 180.930, up 18.30. Gold is getting hit. It's down $8.40, trading at 1805.20. Silver also getting hit. It's down 10 cents at 1965, just off of the lows of the session as well. So metals are getting hit. Equities getting hit. U.S. dollar index is saying not so fast after breaking into the 95 handle like I warned you that it was going to do. It is now at 96.14 after hitting that 95.99 low in the overnight. The euro is off 2 pips at 114.20. Pound sterling is off 22 pips at 125.64. The Aussie is down 16 pips at 69.85. Canadian dollar is up 25 pips at 135.33. Euro yen up 24 pips at 122.28. And the dollar yen is up 25 pips at 107.19. And your Kiwi is down 25 pips at 65.46. Now, the interesting one here is your beans, which are up 4 1/4 at 8.87. Your corn is up 2 at 3.36. It had a rally alert coming into today as well. It did manage to get up to 3.37 1/4 before pulling back. And finally, wheat is off 4 1/2, trading at 5.46 1/4. All right, so that is your look at the markets. Now let's take a look at the market news. If you don't know, Christine Lagarde is talking. The ECB is talking about using all types of tools at its disposal to prop up its stock market. So global stocks tumble as investors weigh Chinese GDP data, which beats estimates but flatters to deceive. China's mainland benchmark index, the Shanghai Composite, fell 4.5%, and Hong Kong's Hang Seng fell 2.1%. China's economy grew faster than expected in the second quarter, latest sign that it's on course for the mythical V-shaped recovery. As the first country to face the coronavirus, China's economic recovery is much further along than most nations in the Western world. I like the way they use words. Now, first of all, you can tell that the West is jealous that China is so-called further along than them. But they was like, yeah, but they got the virus first. But I thought the reports over the last week or so were talking about how China had the second wave and more people sick than the first wave and all this other stuff. And now you're saying, well, they're only ahead of us because they got it first. That's all. They ain't all that. Sound like sour grapes. Sounding jealous. You know what I mean? And you can't have it both ways. Either they're not doing so hot or they're doing hotter than you. Which is it? Twitter stock dies in pre-market after a widespread hack took control of major celebrities' accounts, including Bill Gates, Elon Musk, and Warren Buffett. The company said a coordinated social engineering attack had successfully targeted some employees who enabled access to hackers to its internal tools. Bank of America beat second quarter earnings estimates. The lender saw incomes in its global markets division increase by 81% in the quarter, while its overall revenues were $3.5 billion, well ahead of analysts' expectations. The key thing in this sentence, if you weren't paying attention, is that it said incomes in its global markets. It said nothing about the U.S. All right, it made money overseas. It didn't say anything about the U.S. I guarantee if you say, well, talk to us about your U.S., it would be absolutely shocking. It would be like watching Freddy versus Jason. It would be disgusting. Morgan Stanley also beat expectations, seeing its trading revenues surge. The bank generated earnings per share of $1.96 in the second quarter, ahead of its 1.12 figure expected. Of course, you set the expectations just microscopically low, and then you come up with your final numbers, knowing that you're going to blow past those numbers. So it's just a lowering of the bar. You know what I mean? So it's a good way to finagle things and say, hey, we beat our expectations. Well, if you have almost zero expectations and you say we made $1, then you can say we blew past our expectations. That's an old trick, really old trick. Warren Buffett and Charlie Munger were sidelined in fear during the coronavirus crash, investor Bill Smead says. It is unlikely they have been more scared by economic circumstances in my lifetime, the longtime Berkshire Hathaway shareholder said. Again, now you got shareholders and friends of Buffett coming out and saying basically what a good person is, how great he was, and how he was scared. That's the only reason why he didn't do it. He was afraid for you and your families. That's why he didn't want to risk your money in any type of market activity. You see how they do? We see you, Warren. We see you. Morgan Stanley unpacks 4 reasons why the ongoing tech boom won't end like the 2000 dot-com crash, and shares how you can profit from future gains. Anyone who understands Morgan Stanley going back years is that they are liars. All right, remember, this is the same old school wirehouse that told you to buy in the first dot-com crash. When the dot-coms were falling, it was like, no, we don't believe this is a pullback. It's just a minor thing. You should still be long. You should still buy. If you liked it at $300 a share, you're going to love it at 145. Or if you loved it at 145, you're going to love it even more at 90. Or if you love it at 90, then I know you're going to really love it at 60. Oh, wait, it's trading at $5 right now. Okay, we're going to issue a sell signal now on this stock. That's how they did you. That's how they did you guys in the 90s. You know I'm telling the truth. Remember the name that you don't hear anymore? Remember the person with the 3 names? Remember that? Oh, you don't know who I'm talking about? Abby Joseph Cohen. Remember that name? The Wall Street darling analyst who made $100 million as she parted ways with the firms that she was at? Yeah, man. They all got golden parachutes while the world suffered. They were liquidating positions while you were accumulating positions. They taught you how to buy while they were selling. And you guys fell for it, just like you always do. So go ahead, listen to what they're telling you. Hey, the NASDAQ futures is only down 111 points. Go ahead and buy it. Catch the falling knife and get stabbed in the heart. Why not? Jason Voorhees is your friend. Paul Androlia has a long track record of finding tiny stocks that deliver 10 times returns. He lays out the 4 criteria he looks for when seeking the next explosive pick. Quote, it literally went from maybe averaging 10 to 15% a year, like 100 to 120%. Paul Andriola said in reference to his portfolio's performance. It's not hard to make money in pump and dump schemes, especially if you're the one that's doing the dumping after you get everyone else to do the pumping. The world is full of penny stock gurus, I have to tell you. But it's also full of people who blew up their account trying to do so. Earnings keep coming. Johnson & Johnson and Netflix are highlights. Data on the docket is continuing jobless claims, and the 4-week bill auction are due. The jobless claims already came out, and it was worse than expected. So, where does that leave us, ladies and gentlemen? Are you ready to roll up your sleeves and do some work? Are you ready to put on your big boy pants and big girl pants and dive deep into the economic abyss known as the Depression of 2020? Is you ready? You have to admit, I did warn you, though. I told you what was coming. I said they're coming for your jobs. Oh, yeah, they're coming for your jobs. They already came for some of y'all. I was warning you about that. See, this is what they do. They try to scare you to death. And then when that doesn't work, they force you into a corner and make you fear. So they figure, well, the best way to get people to fear is to take the jobs away. How do we take people's jobs away? Oh, I know, shut down the economy. Let's devastate people. That'll make them scared. Oh, and then we'll tell them, while you're out in the cold because you're being foreclosed on, oh, outside, you can't go outside because there's a deadly virus waiting to get you. That'll put the fear of God in people. And then where do you go? You go to your benevolent dictator, your fascist government, and say, can you please help me? I am in trouble. I am of need. And they say, of course, for I am a benevolent dictator. I will take care of you. I love you. Come here. Give me a kiss. And then they bite your head off because you didn't know that really they were a reptilian snake creature under the skin of and flesh of a person. And when they grab you to kiss them, they bite your head off. That's what we're kind of in right now. Some people are saying, what in the world are you talking about? Well, let me help you, because some of you it hasn't hit home yet, but it will. Oh, it will. You see, you're witnessing a financial extinction event that has been planned and coordinated over many years, and it's now being rolled out unto the masses, unto the unsuspecting public. While everyone else is out there rioting for fake movements that your government has inspired, that is bought and paid for by special interest groups, the very billionaires that you are rallying against are the ones that are financing your movement. Think about it. You see, the lower reaches of the financial food chain are already dying, and every entity that depended on that layer is doomed. Though under pressure from climate change, the dinosaurs were still dominant 65 million years ago until the meteor struck, creating a global nuclear winter that darkened the atmosphere for months, killing off most of the food chain that the dinosaurs depended on. Now, this is what we call fairy tales of lore that you learn in grade school. All right, that is their fairy tale, that is their religion. All right, survival of the fittest. All right, evolution. The ancestors of modern birds were one of the few dinosaur species to survive the extinction event, which took months to play out. It's very funny that they called it that when in reality, they always have to find a way to explain away the thing that they don't want you to go near because, again, they build walls around the truth to keep you out. So when they're talking about that event that happened 100 million, billion, trillion, fulfillion years ago, what they're really talking about is the devastating effect of Noah's flood and the total reshaping of the topography of the earth. That's what they're really talking about. All right, there was no asteroid that killed the dinosaurs. All right, moving on. That's the opening bell for those of you that need to handle some business, which you probably should have handled last night if you subscribe to the PulseWave Price Trigger Reports. If you do not, then you probably have no clue what's going on this morning. You see, it wasn't the impact and shock wave that killed off the dinosaurs globally, according to the lore. It was the nuclear winter that doomed them to extinction. As plants withered, the plant-eating dinosaurs expired, depriving the predator dinosaurs of their food supply. But see, here's the thing, though, that they're not. See, their logic has holes in it. The story has holes in it. If this happened and there was no food and everything died, then where did everything else come from? Are you saying there were two big things? Because if an asteroid came and killed the dinosaurs off and there was a nuclear winter, then no animal can survive. So therefore, where did all the animals come from? If they all died off. If they died, how did they evolve? How can you evolve if you're dead? You can't evolve into something else if you're dead. I digress. This is a precise analogy for the global economy, which is entering a financial nuclear winter extinction level event, or an ELLE, for those that saw the movie Deep Impact, one of my favorite movies. If you haven't seen it, you need to go see it. Deep Impact was an incredible movie. Now, businesses still have all the high fixed cost of 2019, but their revenues are pretty much close to zero. All right, and that's because of the financial nuclear winter that weakens consumer spending and investment, et cetera, et cetera. Now, despite all of this, talking about potential vaccines, no vaccine can change reality. For one, consumer sentiment has shifted from confidence to caution and from spending freely to saving. This is the financial equivalent of nuclear winter. There is no way to return to pre-impact environment. People are no longer going to be spending frivolous when they no longer have a job. Two, uncertainty cannot be dissipated either. There are no guarantees a vaccine will be 99% effective, that it will last more than a few months, that it won't have side effects, etc. There are also no guarantees that consumers will resume their carefree spending ways as credit tightens, incomes decline, risks emerge, and the need for savings become more compelling. In other words, should I spend my last $20 on, let's see, a pair of XJ9000s? For those of you who don't know what that is, that was a generic Bobo version of some fake Jordans. It was a fake version of the fake Jordans. The third issue is that consumer behavior and uncertainty have already changed. And so businesses that cannot survive on much lower revenues won't last long enough to emerge from the nuclear winter of uncertainty and a shift in sentiment. Again, you're pretty much strangling to death and choking to death the mom and pop outfits that do most of the employing. The fourth issue is that assets based on 2019 revenues, profits, and demand are now horrendously overvalued, and the repricing of all assets will bring down the predators, which is the banks. All right, as noted above, the top 10% of households account for almost 50% of consumer spending. Now, these households are older and own the majority of assets, between 80% and 90% of stocks, bonds, business equity, rental real estate, etc. This is the demographic with the most to lose and returning to carefree air travel, jamming into crowded venues and cafes. This demographic has been there, done that, and foregoing fine dining, sports events, concerts, cruises, and not much of a burden, and may actually be a relief. But meanwhile, the entire food chain of landlords, banks, local government, employees depends on enterprise returning to 100% of 2019 revenues. All right, did you get that? They have to return to 100% of 2019 revenues. Now, as tenants stop paying rent, landlords will what? Default on their mortgages, sending banks into what? Insolvency, leaving local government with less tax revenues and employees with fewer job prospects. You see how this is a never-ending cycle? You see how the snowball is gaining in momentum as it is rolling down the incredibly tall Mount Everest economic problem? Now, to a degree, few appreciate the recovery since 2009 has been dependent on overspending, overborrowing, and overspeculating. All right, let's put it out there. All right, since the bailouts and the tarps and all that stuff, what was that dependent on? And even the checks that Bush was sending out, what was that dependent on? It was dependent on what? Spending, borrowing. That's why they put the rates as close to zero as they could, so you could spend more, so you could borrow more. And then what did that allow people to do? It allowed for more speculation. People start buying homes, even buying rental properties and vacation homes. Again, when the speculation bug bites, the result is a boom in real estate and a boom in equity markets. Everybody knows that, right? Now, as spending, borrowing, and speculation all pull back to what would have been normal levels 2 generations ago, the economy collapses because it's become completely dependent on what? Overspending, over borrowing, and over speculating. Now, as consumers and businesses retrench, borrowing declines while defaults and bankruptcies eviscerate bank profits and balance sheets. Why do you think they were very lax in the last bank stress test? They changed some rules because they didn't want to expose the truth. They want to keep this game going as long as they can. So that, so now they realize they can't tell you that nothing is wrong. So what they do, they say, okay, only a little bit is wrong. They don't want you to know the real nasty truth that not only is a monster hiding under the bed, there's a bunch of skeletons in your closet. Now, as spending declines, businesses with high fixed costs and pre-pandemic business models, crowding people together in close quarters, cannot generate enough revenue to survive. The business model, it is dependent upon large crowds. So as the collateral of commercial real estate and profit streams collapse, assets are repriced all down the food chain, reversing the wealth effect. As people feel poorer, they borrow and spend less. The banks tighten the credit purses and don't give out as much loans, creating a feedback loop of lower valuations, lower spending, lower profits, lower borrowing, all of which feed back into each other, pushing everything lower. It's almost like, sell programs in the market. Once the bots sniff out that there's blood in the water, all the machines go into overdrive and everyone starts selling and shorting, and the longs get out of the market. And the only way to get out of the market from a long position is with another what? Short position. You have to sell something in order to offload a long position when you bought something. So the longs liquidating adds to the shorting, because now you're selling more sell orders. So the longs are running for the hilt. The robots are coming in and shorting and selling everything, and all of your circuit breakers are falling through the floor. It's the way it works. It's the way it works. The lower reaches of the financial food chain are already dying. Can't you smell the corpses? And every entity that depended on that layer is doomed. The small businesses die off, and that brings down distributors and banks and landlords and employment. And as this layer collapses, the then top predators will starve to death as well. Who are those? Big tech, healthcare, higher education, tourism, local tax revenues, etc., etc. See where we're going? The clouds are spreading and thickening, and the dawn sky is tinted an ominous red. Do you guys remember that part from V, the new version of V that they made? And the red dawn was like the last thing, and they released it and the sky turned red. Is this starting to sound familiar now? This is a financial extinction event, and the Fed's pathetic shamans cannot reverse history. You can't. You can't maneuver and talk your way out of this one. It is impossible. It is impossible. You can't do it. You will not be successful. You can't do it. And I think they realize this a little bit too late, however, but they do realize it. So now the question is, what do you do? What are you going to do about it? I'll tell you what you're going to do about it. The smart people are going to come over to PulseWave Trading, and they're going to say, screw you. You're not going to keep me in a position of poverty. I'm going to learn how to trade and extract the money I need from these markets. Even if they do fall and drop to zero, I'll just be short and I have 1 million puts. But here's the problem, though, folks. I've given you the outline. I've given you the shell, the framework of the situation. But now let's have a grown-up conversation about the 50 million Americans who have now filed for first-time jobless benefits since the lockdowns began. Despite the hope-restoring non-farm payrolls recovery and the overhyped bounce in soft sentiment surveys, which are biased by their nature as diffusion indices to bounce back hard. For the 17th week in a row, over 1 million Americans filed for unemployment benefits for the first time. 1.30 million was slightly worse than the 1.25 million expected. All right, that's a lot of people. That brings the 17-week total to a whopping 51.275 million. Over 51 million. That's dramatically more than at any period in American history. Period. However, as we look deeper into this, the second derivative is slowing down drastically, even though the 1.3 million rise this last week is still higher than any other week in history outside of the pandemic. Continuing claims did drop very modestly, but hardly a signal that reopening is accelerating. See, they want you to believe, oh, we're in the third and fourth stages of reopening, and some places have already reopened completely. That's definitely not confirming the payrolls or sentiment data. Sorry. Now, if you break things down by state, it is perhaps not surprising that Florida, which has seen a surge in new COVID cases also had the biggest increase in initial claims, which rose by over 62,000 in this past week alone. And that's more than double the second biggest increase, which was seen in Georgia. Now, with that said, a surge in COVID cases does not explain why Texas, which has also seen a sharp increase in new cases, was the state with the second biggest claims decline. Very interesting. Now, as noted previously, what is most disturbing is that in the last 17 weeks, far more than twice as many Americans have filed for unemployment than jobs gained during the last decade since the end of the Great Recession. All right, so 22.13 million jobs gained in a decade, but 51.275 million lost in 17 weeks. Worse still, if that's not all bad enough, the final numbers are likely to be worsened due to the bailout itself and its fiscal cliff. As a reminder, the Coronavirus Aid Relief and Economic Security CARES Act, passed on March the 27th, could contribute to new records being reached in coming weeks as it increases eligibility for jobless claims to self-employed and gig workers and extends the maximum number of weeks that one can receive benefits and provides an additional $600 per week, but only until July 31st. We're halfway there. Today is July the 16th. Time is running out. Finally, it is notable we have lost 364 jobs for every confirmed U.S. death from COVID-19, which is 137,419. Was it worth it? The big question remains, what happens when the $600 CARES Act bonuses stop flowing? That is a very good question. And if that wasn't bad enough, hang on to your seatbelts because we're going even deeper down the rabbit hole. It's already starting. I told you, I warned you that this was going to happen. Mortgage delinquencies suddenly soar at record pace. And it's even worse than that. Mortgages that are in forbearance and have not missed a payment before going into forbearance don't count as delinquent. Did you know that? Once again, mortgages that are already in forbearance and that have not missed a payment before going into forbearance don't count as delinquent. They're reported as current. And 8.2% of all mortgages in the U.S., or 4.1 million loans, are currently in forbearance, according to the Mortgage Bankers Association. But if they did not miss a payment before entering forbearance, they don't count in the suddenly spiking delinquency data. Go figure. Now, the onslaught of delinquencies came suddenly in April, according to CoreLogic, a property data and analytics company, owner of the Case-Shiller Home Price Index, which released its monthly loan performance insights. And it came after 27 months in a row of declining delinquency rates. Now, these delinquency rates move in stages, and the early stages are now getting hit. Now, transition from current to 30 days past due. In April, the share of all mortgages that were past due but less than 30 days soared to 3.4% of all mortgages, which is the highest in the data going back to 1999. You got to go back to the 1990s. You got to go back to the 20th century, because we're now in the 21st century. You got to go back to the 20th century to find a comparison in the data. Now, this was up from 0.7% in April last year. During the housing bust, this rate peaked in November 2008 at 2%. You see the compare when you compare apples to apples, you get a better overall picture of what's going down. Now, not only that, but from 30 to 59 days past due, which is the next category, The rate of these early delinquencies soared to 4.2% of all mortgages, the highest in the data going back to 1999. Again, we're in the 21st century. You got to go back to the 20th century to find comparable data. This was up from 1.7% in April last year. Now, when you go to the from 60 to 89 days past due category, as of April, this stage had not yet been impacted, with the rate remaining relatively low at around 0.7%, which is up from 0.6% in April last year. It's still an increase. A fraction of an increase is still an increase. If you say, okay, let me take this 6-inch blade and put it 4 inches into your stomach, it's still painful. And if I say, okay, now we're 4 inches in, let me put it another inch in. Now I'm 5 inches of the 6-inch blade in your stomach. Is it really going to make that much of an impact? Probably not, but you're still going to feel the pain. Now, this stage will jump in the report to be released a month from now, when today's 30 to 59 day delinquencies that haven't been cured by then move into this stage. Now, the next stage is the serious delinquency stage, 90 days or more past due, including loans and foreclosure. As of April, this stage had not been impacted, and the rate ticked down from 1.2% from 1.3% in April a year ago. So just a little small percentage of a decline. So you got a little bit better. But we should see the rate rise in 2 months and further out. Finally, the overall delinquency rate, 30 plus days, jumped to 6.1%, up from 3.6% in April last year. This was the highest overall delinquency rate since January of 2016, on the way down. These delinquency rates are the first real impact seen on the housing market by the worst employment crisis in a lifetime, with over 32 million people claiming state or federal unemployment benefits. There is no way, despite rumors to the contrary, that a housing market sails unscathed through that kind of employment crisis. All right, it's just no way in the world to avoid that. Remember, we talked some time ago, I laid out for you the situation that pretty much all of the exits have been blocked. Katie barred the door. Everything has been blocked, not making it a smooth situation for most people. Because again, the normal hedges have all come down. The normal inverse market correlations have all collapsed. It used to be, if the stock market was struggling, you would just flow to the bonds. No problem. Just go right to the bond market, park your money there and get some interest on your money, right? Then too, you had another less popular route, which is mainly for the wealthy. They could park their money in nice blue chip stocks that paid really nice, hefty, consistent dividends, right? And those stocks, traditionally would not really move that much. Didn't matter what the market condition was, as they were almost flatlined. All right, because the whole idea wasn't capital appreciation; it was really income. So you could do that, or you could say, okay, well, if that's not working, I'm going to go into the precious metals. I'm going to go ahead and get into some gold, park my money there. You know what I mean? Well, all those traditional means have been blocked off. So you see nowadays when bond prices are falling with equity prices, and then gold is falling with equity prices, and then you got oil, equities, gold, and bonds all falling and collapsing in price together. What is one to do? You say, okay, I'll go to the cryptos, and then you see cryptos falling along with the equity market and the bond market and the gold market and the oil market. So it's like, what is one to do, right? Well, here's the delinquency hotspots. The overall delinquency rate rose in every state. I'll say that again. The overall mortgage delinquency rate rose in every state. But there were some real hot spots in terms of the percentage point increase in the delinquency rate in April compared to April a year ago. Of course, number one, you know who that is. Come on, you know the answer. New York, 4.7 percentage points increase. New Jersey was next with a plus 4.6 percentage points increase. Nevada, plus 4.5 percentage point increase. Florida, plus 4% percentage point increase. Hawaii, plus 3.7 percentage point increase. Yeah. Now, it's funny because, cost of living in New York City is high. Cost of living in Miami is high. Cost of living in Hawaii is high. Nevada, I really can't see why that one would be so high. Probably because of all the speculation of all the buildings they were building. They went into this big building frenzy, and that's probably why they got hurt. All right, the worst hit metros are tourism destinations, and New York City was the most devastating and deadliest outbreak of the pandemic in the US, which occurred. Now, there are massive increases in the delinquency rates in April. Again, Miami with a plus 6.7% point increase. Was it Kahulu? I guess that's how you say it. Kahului in Hawaii. Kaloha, however you say it. Anyway, plus 6.2 percentage point increase. New York, 5.5% percentage point increase. Atlantic City, New Jersey, 5.4 percentage points increase. Las Vegas, Nevada, 5.3 percentage point increase. Now, with home prices expected to drop 6.6% by May of 2021, thus depleting home equity buffers for borrowers, you can expect to see an increase in later stage delinquencies and foreclosure rates in the coming months. And that is what CoreLogic said in their report. With over 8% of the mortgages now being in forbearance, there is a lot of uncertainty about them as well. How many of them can exit forbearance or the extension and return to regular payments, and how many of them end up exiting forbearance and becoming delinquent. Now, CoreLogic expects to see a rise in delinquencies in the next 12 to 18 months, especially as forbearance periods under the CARES Act come to a close. Now, to what extent the delinquencies deteriorate further depends largely on the labor market and on unemployment, and that remains a horrible mess at the moment. Again, these are facts. All right, facts that they're not really wanting to talk about in the media, but it doesn't make it go away. All right. Now, again, one of the factors that determine this whole housing situation, one of the factors is employment. Okay. That is going to be a big issue. So in less than 14 days, the government will sever its $600 per week unemployment lifeline. Even scarier than the pandemic for some in this country is the idea that they may have to actually get up off the couch, look for employment once again, and earn money the old-fashioned way, doing something productive. Now, it's now less than 14 days until Americans surviving on $600 a week in extra unemployment benefits could see their lifelines come to an end. The program, which was designed to increase unemployment during the pandemic, has accounted for a majority of the Treasury's $100 million in jobless payments last month and is scheduled to end before August, according to Bloomberg. At the same time these benefits end, the Fed will continue to pump billions, if not trillions of dollars into capital markets, facilitating an even further spread between the haves and the have-nots in the country. So let's examine that for a quick moment. Okay, so here's the situation. The Fed said, okay, this is what we're going to do. We're going to extend the payment and the unemployment benefits by $600 a month, right? Boom. So that takes care of the little guy, but only until July. However, for the elite, for the rich, or for the people who are in the know, who subscribe to the PulseWave price trigger reports, the Fed said, we're going to do you a better solid than that. We're not giving you a handout. We're going to go in here. We're going to pump up the stock market for you so that you can experience share price increase in your portfolio. That's how we're going to bless you. So the Fed blessed the poor man with the $600 a month, but only for a limited time. But for those that are in the know, who are in the game, he said, we're going to bless you the most because we're going to prop up this market that you in. All you got to do is pick a stock and go long, and we got your back. So you're going to make a lot more than some $600 a month with the Fed's blessing by propping up the equity market. Most people never get to that point. They always stop short of what the Fed did, but they don't think about the impact of what the Fed did and who they are really blessing, who they're really working for. They're working for those that are in the know. They're working for those that are in these markets. And they don't care about the $600 person. They're taking that money away. They only gave you that money temporarily to pacify you so you wouldn't be tearing people's stuff up in the street. But that didn't really work because you were still tearing up people's stuff in the street. All right, so for many Americans, it also means that they may have to dive into the meager savings that they have, if any. Most people have not been able to save a thing, even with the extra $600. All that did was help them to pay some bills, but that's not helping anybody save anything. Stimulus talks in Washington seem to be stalled at the moment, and until they progress, there will be no extension of the benefits. That's what everyone's banking on. They're praying for an extension of the benefits. Democrats are calling to extend the program. No surprise there. And the Trump administration is battling to try and cap the amount that Americans can receive, rightfully claiming that the extra unemployment is a disincentive to return to work. But see, here's the say, it's not really a disincentive. You know, back in the day, you could say that, but you can't say that now because the jobs are going away. You got now you have even more people battling for fewer jobs. It doesn't matter what that they extended or not, the situation's still going to remain the same. If you only have 1,000 jobs available, but you have 1 million people applying for the 1,000 jobs, you're still going to have a big mess on your hands. Employers are also standing with the Trump administration, arguing the obvious. The bump in unemployment has disenfranchised potential workers from going back to the job market. So there is some truth to that part. But despite this, job postings are lower by about 23% than they were in 2019. So again, we go back to the situation. It's true, if you keep giving them the extension and unemployment benefits, that will make people say, why should I go to work when I can make more on unemployment? But here's the thing, though. There's less employment available. So it's almost like those that are the most studious or the ones that will hurry up and snatch those jobs up real quick. Yeah, you're going to make less than you would on the unemployment, but at least when that unemployment thing runs out, you won't be one of the ones looking stupid because at least you'll have a job. See what I'm saying? And they'll be out there trying to find one that doesn't exist. One 63-year-old former maintenance supervisor interviewed by Bloomberg called the extra $600 per week a lifeline to our pre-pandemic existence. It's going to put me in an extremely uncomfortable and possibly threatening situation with my housing, end quote, he said about the program potentially ending. 33-year-old Amanda Steinhauser of Blackwood, New Jersey, is earning about twice what she was making at her job from unemployment assistance. She used the bump in pay to pay off credit card debt and save hundreds of dollars per week. But the fact that she is making more now than she was previously hasn't stopped her from petitioning to keep the benefits, deeming them necessary to meet her new standard of living. She says that the loss of the benefits could cause her to run through her savings, which was ironically helped along by unemployment. Quote, I have been looking for a job ever since I was laid off back in March, and I haven't been able to find anything. If I don't have that 600, I know I'm going to be screwed, end quote. See, here's the situation yet again. Notice how things have changed. It used to be a place and a point in time where the haves looked down on the have-nots and treated them viciously. They used to make fun of people that were on welfare. They made fun of people who are living on unemployment benefits, call them lazy and all this other stuff, never taking into account people's individual situations. But now the haves have become the have-nots, and they find no problem with living on the government dole. You see the hypocrisy that is coming into play. All right. This should be a major wake-up call to how you treat your fellow man. Now, 42-year-old Jill Haber, a former marketing professional, says the benefits have helped pay the bills but don't make up her previous salary. She says she's lucky to have savings. I'm lucky in that I have to dip into, Haber said. A lot of people don't. Former bar manager Raven Gilbert was laid off in March. She says even with the added benefits, it still falls short of what she was making earlier this year. She qualifies for just $134 extra per week. Without it, quote, I don't know what will happen. I don't know that I'll be able to make my bills or buy enough food, end quote, she concluded. Maybe someone should just tell Raven to become a corporate bond fund manager and the Fed will take care of the rest. She can go from $600 a week in free money to trillions in free money overnight. Or perhaps she could learn to code. And of course, there's always Walmart. Unbelievable. 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 This is where we are, ladies and gentlemen. I know it's hard to grasp. I know it's hard to believe, but let's just do a reality check with this whole job situation. All right. It's not coming. After 2 straight months of better than expected, yet still depression era style job gains, it looks like July could be a reality check for the V-shaped recovery crowd. Gains look as though they are going to slow sharply or even reverse this month in July, according to Bloomberg. These predictions come after places like California have once again shuttered their economies, closing dining and shutting down all businesses in hardest hit counties. Washington has followed suit, stopping its relaxation of restrictions in the state for the next 14 days. According to the job listings on Glassdoor.com, openings have fallen 5.5% over the last 2 weeks, inclusive of all 50 states, not just the ones that have shut down. Now, of course, this could also be an indication that jobs are filling up, but it's more likely a signal that companies are pausing their rehiring efforts. The jobs report, excuse me, is due August the 7th and will include whether or not respondents have a job this week. Payroll counts are inclusive of those who receive the check for the pay period ending July the 12th. The timing for a plunge in job gains could be ugly. There's just 14 days left for that $600 per week in extra unemployment benefits the government is offering and just waving in front of you like a carrot. Morgan Stanley is predicting a meaningful chance of July's payrolls dropping based on the nation's economic trends. Mark Zandi of Moody's Analytics has predicted a gain of less than 1 million, inclusive of a 200,000 boost from temporary jobs related to the U.S. Census. Fed President James Bullard also said this week that he is predicting smaller job gains in July. He predicts that if the pandemic eventually goes under control, however, job losses should fall rapidly. Now, Bloomberg Economics said that we could see some preliminary impacts from new shutdowns in the figures for July. The concern is that what will happen going forward into the end of the year? How about into 2021? Will there be enough jobs to create enough personal income so that it can support personal spending growth? Russell Price, senior economist at Ameriprise Financial, commented, quote, "The developments since the June report had obviously not been very encouraging. Leisurely and hospitality jobs, which were initially rebounding well after collapsing at the pandemic's outset, will in particular see their recovery further delayed," end quote. Morgan Stanley economist Robert Rosner concluded, quote, "We will see volatility in the data along the way. In this case, we do not think we might see some of that volatility showing up near term on the labor market front," end quote. Once again, as we further examine the unemployment situation in the United States, you can see we have very little to be encouraged about. Now, if that wasn't enough, there's even more. It's more. There's more. There's more. Global fertility. It looks like the Georgia Guidestones are getting several bullet points checked off here this year. One of those is to keep the population of under 500 million. Global fertility decline will see population in over 20 countries halved by 2100. A new study from the Institute of Health Metrics and Evaluation, IHME, at the University of Washington and reported in AFP finds that the Earth is projected to have 2 billion fewer people by the next century than current United Nations projections forecast for normal global development. Remember, they say, oh, there's too many people on the Earth, we're overpopulated. You know, that whole nonsense that's been debunked year after year. Well, guess what? Now you don't have to worry about it. We're having less and less babies, according to this latest report. And forecast a population peak by 2060s at an estimated 9.7 billion people, after which a steep decline will ensue down to 8.8 billion by 2100, because women are having fewer children. Currently, the global fertility rate stands at about 2.4%. All right, hold on. My dog is barking. There's someone at my door. Let's take a quick commercial break. Okay, I'm back. Sorry, I don't have any music to play, but it is what it is, man. You know, it is what it is. One of these days, I will have some music to play. So, where were we? Okay, so basically, what we have here is a situation where I guess people are so busy protesting and rioting that they don't have time to do traditional indoor things. Hint, hint, right? Now, here's an example of what we're looking at. In Japan, from around 128 million people in 2017 to 60 million in 2100. This is really fun. Thailand, 71 million to 35 million. Spain, 46 million to 23 million. Italy, 61 million to 31 million. Portugal, 11 million to 5 million. And South Korea, 53 million to 27 million. Astoundingly, or perhaps entirely to be expected, mainstream media is hailing it as a success story, given that it's about sperm count, but more and more women simply choosing not to have children. And that's what it's really about. So it's kind of like, no wonder they're saying it's a success story, because again, keeping that population super low, you figure they got you going with the infertility issues, they got you going with the coronavirus, they got you going with fluoride in the water and all this other stuff, and all these chemicals and poison of the food, and the autism rates exploding. You put all that together in one big mix, and yeah, that's going to make women say, you know what, I don't think so. Now, for example, BBC wrote, it has nothing to do with sperm counts or the usual things that come to mind when discussing fertility. Instead, it's being driven by more women in education and work, as well as greater access to contraception, leading to women choosing to have fewer children. In many ways, falling fertility rates are a success story, BBC concluded, echoing some of the authors of the original study. So again, we got situations where they're saying that even with all this going on, people are choosing not to have less and less children. I mean, think about it though. It kind of makes sense, because if there's no employment and people are struggling financially, then that's going to kind of make people not want to start families, if you know what I mean. Okay, so every time there's issues that go on in the economy, every time there's any kind of social unrest or whatever, fill in the blank, you got your people that like to come and say, see, I told you the world's coming to an end, right? That's what they say. So here's one for you. Alistair McLeod warns that the dollar is on its way to zero, probably by the end of the year. Now, I can understand why people would want to believe that based on what we see going on and what we know is going on, right? I get it. But come on, let's be honest. Again, we talk honest. If that were the truth, then we wouldn't be here talking right now, because this was supposed to happen, like I told you guys, back in 1994. The first real scare of this magnitude, talking about the dollar and all this stuff from deficits, it was 1994. They didn't think we would make it to 1995. All right, that was the first of its kind when it raised its head. Then we went from that to, okay, when the NASDAQ bubble bursted, okay, yes, now we're in trouble. We're going to zero. Didn't happen. Then when 9/11 happened, technically speaking, the dollar did go to zero that day. All right. It did. But they erased everything and said, oh, it didn't happen. 9/11 never happened. So that didn't happen. Then came the financial mortgage crisis, the A-paper mortgage crisis of 2007, 2008. And everyone said, oh, the dollar's definitely going to zero. That didn't happen. Then it was supposed to happen again in 2011. It didn't happen. Then it was supposed to happen again in 2013. It didn't happen. Now here we are in 2020, and they're saying, oh, it's definitely going to happen now this time. Dude, do you know how many documentaries and YouTube videos were made about the dollar going to zero by this time or by this point and blah, blah, blah? Never happened. Never happened. If you have not done so, I would highly suggest that you peep my documentary series that I did called There Is No Collapse. I think it'll be very eye-opening for you. Follow that up with the Fed versus Bitcoin and central banks versus the blockchain. I think you will have your eyes finally opened for good. Now, finance and economic expert Alistair McLeod says the gold market is extremely dangerous as far as the bullion bank swaps and trading desks that at some point soon are going to have to deliver physical gold they do not have. Now, I've dealt with this issue for years because you know what he's talking about when he used the word delivery. He's talking about the paper market. He's talking about the COMEX. All right. As I have already explained ad nauseum, ad infinitum, not all gold futures contracts are deliverable. That's number one. Number two, just because you have a futures trading account and can trade gold futures does not give you the right to take delivery either. You will never take delivery. The only way you'll be able to take delivery is at time of you opening your brokerage account. You specify that you are basically a hedger or a producer and that you plan on taking delivery. They set you up with a special type of an account. You will not have the benefits of the lower initial margins and maintenance margins and span margins because, again, you told them you're not doing this for speculation. You're doing this to take delivery. So they're going to treat you like a mill. All right. They're going to treat you like Exxon. All right. So when you go and you buy gold, they know you're taking delivery. You're not trading. You're not shorting the market, going long the market. You're not doing that. You're not trading for cash. You're trading for physicals. So they're going to set you up, which means that you're going to have full futures margin every time you buy a gold futures contract. Not only that, you're going to have to put up all of the storage costs and delivery costs and fees and interest and taxes, all that stuff. You got to pay all of that. That's coming out of your pocket. You got to have full futures margin. All right, because you're a special type of an account. You're a hedge account. All types of paperwork has to be done ahead of time. And then after that, what do you need to do? Nothing. You just go ahead and buy the gold futures contracts with the delivery, pretty much the big contract, the regular gold contract, and then you take delivery. You hold the thing until expiration. I mean, you're not trading. You buy it and then you wait and take delivery. They always have enough gold to take delivery. All right, because on those type of accounts, those accounts are cross-checked in reference with the CFTC and your clearing firm. They know how much gold is in storage and how many people are trading to take delivery. It's a very sophisticated situation, and there is no way under any circumstance that situation would break down. All right, this thing has been going on for darn near close to 100 years now, and it has never broken down. There's never been a situation where people who were owed delivery were not able to get and take delivery. Never happened. Never happened. Never happened. Never happened. Never happened. So I don't know why people keep touting that. I think the only reason why they do is because the majority of people know nothing about what they're talking about. So they think these people are wise sages and they know all things when they know nothing. I don't know if they're doing it on purpose to mislead the audience and to put scare in people, or and to get views and clicks and likes, or if they don't know what they really just don't know what they're talking about. Now, I've given you the facts, I've given you the truth, but now I got to go to the flip side because we examine things. We don't just talk about it or talk around it. We go right into it. So let's go deep. Here we go. Is it possible that it can happen? The answer is sadly yes. The only way it will happen is because of corruption and because the powers that be want it to happen. All right. Just like they did, just like we didn't think that John Corzine would happen, but it did. And it broke the spirit of the commodities market when John Corzine and his firm did what they did. All right. $1 billion of theft out of people's accounts is no laughing matter. All right. And he did not do a day in jail because he's part of the system. He did what they told him to do, what they wanted him to do, and that's what it was. So you have that first shock. Then the second one, of course, would be if there was some type of a failure of the market. But see, I don't think people understand what that means. If there were to be an issue like that with delivery, not only would it shake the entire commodities market, but it would be a world-ending event. I don't think people understand the role that the commodity futures markets plays. I don't think people truly understand it. For that to fail means the economy has failed. It means finance has failed. And it will just not have a United States impact. It will be a global impact because the commodity futures game is a global game. I don't think you understand the ramifications and repercussions of something like that. You don't want that to happen. That's the one thing you never want to be right about. Because if that happens, then the sum of all fears is happening. The day that happens is the same day that a nuke explodes in a major city. That's how serious that is. And that's the only thing I can compare that to. Because now you're talking about a breakdown of everything that you know. Do you not understand that everything that you enjoy is because of the commodities markets? So if that breaks down, then you have no global trade. You have no trade, period. Goods and services stop flowing. Food stops moving. Because now you got to break down the commodities markets. So no one's getting no corn, wheat, soybeans, nothing. You starve to death. No commodities markets means you're not eating. All right? No commodities markets means that you have no energy. The ramifications and repercussions of such a situation is unfathomable. So I just had to point that out to you and break it down so y'all know what time it is. All right? You got to talk about it. Now, according to McLeod, though, he explains, quote, I find it difficult to see how they can close it. The possibility of a default and the possibility of a force majeure is increasing all the time in this current situation. This is a difficult thing to predict, but unless someone can show me there is a way out of this, I can't see how these banks can be rescued, end quote. He's mixing two different things, and now he's talking about the banks. Don't say, you can't say, oh, the delivery is happening. He's mixing a lot of things here. All right, so the bank situation is something totally different. So the only way the banks can be saved is if they can deliver tons of physical gold they likely don't have, McLeod says, which they don't have, not likely have, they don't have, end quote. McLeod thinks failure to deliver gold is coming soon, where the contract will be settled in cash and not physical metal. How many times can the gold market do this, McLeod says? See, now he's talking like he don't know how the commodities markets works. Like 99% of all commodities trading transactions are settled in cash, man. Not all commodity contracts are settled in delivery. They're settled in cash. Does he not know that? Does he not know that when I put on a trade in the Russell futures, that it's going to be settled in cash? What are you going to do? Deliver me Mr. Russell at my door? Here you go. You bought a Russell contract, and here you go. This is a settlement. Russell's coming. He's at your door. Cut it out. Stop. He says, quote, I think it will be the end of the futures market because nobody will trust it as means of delivering gold. I mean, it would have demonstrably failed. So why would you play with it again? Of course, the failure of COMEX contracts is a very, very serious issue. First of all, again, that doesn't make any sense. Again, you're not talking sense. You don't make any sense. And notice how when they quote them and they write these articles and stuff, they never tell you about how the markets actually work. They're not addressing how they normally work each and every day and how that's never ever happened because of the nature of the markets. They're cash markets. They're settled in cash. Delivery is for the big manufacturers, for the producers, all right, for the hedgers. All right, Mr. Farmer Brown is hedging, who's growing wheat. Kellogg's is hedging because they're buying the wheat from Mr. Brown, or there's a mill who buys it from Mr. Brown and they process it and then they sell it to Kellogg's. All right. So no, you're not a producer, you're not a mill. All right, come on, really? How many times do we have to talk about this and it keeps staying in the news? What happens to the price of gold? McLeod says the price is already on its way to infinity, or put more accurately, the dollar is on its way to zero. First of all, as we speak right now, gold is not on its way to infinity. Gold is down $3.90 at 1809.90. If I would only agree with him that gold is on its way to infinity if we've already taken out the highs. We have not taken out the 1900 highs. Therefore, gold is not yet on its way to infinity. Can it go and explode? Absolutely. I've seen it do it before on 9/11. I told you it was like $10,000 an ounce before they closed the markets and erased all the trades. So yeah, it can happen because technically it already has happened before. But based on what he's saying, no. The question I think really want to know the answer to is how long will that take, he says. In his view, not very long. Probably by the end of the year, because we've got another thing happening in the background, and that is we have a banking crisis developing. I agree. We've always had a banking crisis. We've never not had a banking crisis. I agree. Fractional reserve current, banking is in itself built on sand and can collapse at any moment. I agree. But they have precautions they've taken and they've done things. I've talked about this before. You think there's going to be a run on the bank, you got another thing coming. They tried that back in 2008, and you saw what happened. This is the natural consequences of the contraction of bank credit, he says. This is the effect of tariffs on top of that. Turn a normal cycle of bank credit contraction into a 1929 to 1932 horror show. If you have a banking collapse, then those assets values will just go down in the pan. The next thing, of course, bond yields start rising because of the inflationary implications of the financial collapse. At that stage, government financing becomes impossible because governments are in effect bankrupt. He doesn't understand that the governments of the world already have been bankrupt. They've been bankrupt for decades. They were bankrupt before we were born. Ever since the founding and implementation of the central banking system, every country on the earth is broke because the central banking system owns the debt of that country. Now, not every country has a central bank, and that's one thing that this is gnawing at them. But those that do are beholden to the central bank. So yeah, again, you're setting up a straw man and you're knocking it down, man. That's a straw man argument. We already know that. Again, he's talking in the wind. He's talking in the air. Now he says the dollar and bonds all go down together and explains. Well, see, again, that's not true. Historically, the correlations are supposed to work something similar to that, but we know market correlations have been eroded and destroyed over the past couple of decades. So that was true in 1995. It's not true in 2020. His quote says, I think the problem of the COMEX are going to happen considerably before that. I think they're going to be tied into a wider banking crisis. A banking crisis is certain. I cannot see how it can be avoided. If our endpoint is the purchasing power of the dollar goes to zero, then you can see $1,800 for the price of gold. Well, it's already at $1,800. What are you talking about? And $19 for the price of silver is chicken scrap compared to where it's going to go. All right, so he says it's going to go higher than that. All right, well, that's yet to be seen. So this is a major move that is happening, not because they're buying gold and silver so much, but because people are beginning to realize what is happening to the purchasing power of the dollar. That's been over the last 100 years, dude. Where have you been? The pound, the euro, and so on and so forth. Yeah, but the pound and the euro are doing much better than the dollar. Their prices are much higher than the dollar. So yeah. Okay, that is the thing to keep in mind. I think the dollar will be destroyed by year end, and the price of gold and silver is infinity. I think the banking crisis could start in a month. Actually, the banking crisis started before the pandemic, dude. The economies have been in trouble since before the pandemic, dude. All right, look what's happening to their balance sheets. I think their collapse is likely to be so rapid that in the absence of any other information, the best thing to do is hold on to your gold and silver as an insurance policy just in case I'm right. First of all, you should have been doing that anyway. Always be stacking, okay? ABS, always be stacking. Doesn't matter what the economic climate is, always be stacking. This dude doesn't know what he's talking about. He's probably never even traded a commodity futures contract a day in his life. All right. The ignorance of these statements. Again, you set up these straw arguments without going deep in and giving people a full orbed view of what you're talking about. You're just spitting nonsense, dude. We already know the problems and what's going on, but it's not a collapse. It's a repricing, a redistribution. It's a new system that's coming into play. All right. Hope part of that one world digital currency and all that good stuff, all that jazz. That's what this is about. All right. Now, as far as financial collapsing and stuff, if there is anything close to that, it's done by the central banks on purpose. Remember, all the booms and busts are the doing of the Federal Reserve and central banks over the past few decades. Okay. And matter of fact, you can go back to their inception back to 1913 and 14. Ever since they've been installed, this is what the situation has been. All right. So, yeah, again, hogwash. You see how you got to look at language. Look how they set up the arguments, you know, around their thesis. All right. And it doesn't fit. They're trying to force a square into a round hole. It doesn't work. It breaks down. The logic and the argument breaks the heck down because they're not really dealing with the truth of the subject. It would have been better to say that in light of what's happening with the US itself, the dollar, you can see the dollar weakening. Now that is something that I've been talking about every day at the end of the day report. You've seen the charts, you've seen the system give you the buy and sell alerts, crash alerts. Yeah, that part is true. But all the other stuff about he had me until he started talking about the COMEX. All right. I was right there with you when talking about the dollar. I got you. The banking crisis, I'm right there with you. But when you said the COMEX, see, now you don't know what you're talking about. All right. It's not that it. So yeah, I don't know anything. They've been talking about that for a minute too, Thomas. I see you. I know what you're talking about. Yeah, and that's been on. They've been talking about that forever, also, man. Um, Again, ad infinitum. They just talk. They love to hear themselves and talk. That's all they do. Talk. All right, but talk is cheap. Back it up with facts and truth, and stop trying to scare people to death with your nonsense. All right. Keep it 100, man. Stop playing around. Stop playing games. This ain't real. And like I say, if the COMEX were ever to default, it's because they wanted it to, not because there's something wrong with their system. They've been using the same system for the past 50 plus years, and they've had no issues. Even when John Corazon did what he did with the $1 billion situation, people still took delivery. All right. Exxon Mobil, they still got their gas. They still got their oil. What you talking about? Kellogg still got their wheat and their corn. All right. It didn't stop flowing. The corn and wheat didn't stop flowing. So cut it out. All right, folks. That's all we got today. We have to save something for tomorrow, right? Got to save something. You can't just do it all in a day. But take take what we talked about today with the whole unemployment situation, you know, take it to heart, because it is getting worse. All right. And I really don't see how they're going to just create jobs out of the sky. I don't think that's possible. Trump tried. I knew he was going to try. I knew he was going to say, you know, jobs and help the economy. I knew that was coming, but that was only temporary. All right. So I'm just saying. All right. With that being said, you know what it is, man. PulseWaveTrading.com. Come break bread with us. Learn how to do this. And remember, bulls make money, bears make money, and pigs get slaughtered. So remember to take what you can and give nothing back. And I'm out. Smash that like button. And I'll see y'all at the end of that report. Peace.